Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. The market has been in an upward trend since last week. Today saw a little correction. Goldman Sachs, the second largest investment banker in the world, has come up with top 10 investment ideas for India in 2025. They cover stocks in various sectors like finance, consumer discretionary, renewable green energy, internet, to name a few. Let us look at these recommendations, what the stocks are, and let's take a deep dive into why they think these stocks are good investment options in 2025 and our take on it. So, let's start. First stock is HDFC Bank. Well, HDFC Bank is the largest private sector bank with a consolidated loan book of more than 25 lakh crores following its 2023 merger with HDFC Limited. In quarter 4 of financial year 2024, the bank reported a 37% year on year growth in its net profit to 16,512 crores while maintaining a healthy net interest margin of 3.44%. The stock is currently trading at 1800 levels. Goldman Sachs has set a price target of 2090 rupees per share, which represents roughly to 16% uptrend. Now, the bank is expected to benefit from India's credit penetration growth, which still sits at 58% of GDP. Compare it with China's 175% of GDP, so you can see the scope of growth in credit penetration. The bank's digital transformation initiatives includes mobile banking app with over 85 million users, which positions it well to capitalize on India's fintech revolution while maintaining its core banking activities. There are certain risks that we as investors should be aware of. Now, the bank faces challenges including deposit growth constraints, with its CASA ratio declining to 37.7 in recent quarters. Net interest margin pressure from rising competition and the RBI's focus on unsecured lending could impact profitability. Additionally, integration challenges from merger with HDFC continue to require management attention. Our take on this recommendation? Well, HDFC Bank remains a solid long term play. It is part of the core investments of most portfolios. The 2.5x price to book value multiple recommends a reasonable valuation for this stock. But whether the bank is able to arrest the CASA decline is what investors should watch out for. It has also strategized to penetrate into rural areas with 10,000 plus banking correspondents. Now, this could yield a significant growth as financial inclusion accelerates. What investors should also look out for is the RBI's increased scrutiny on unsecured lending, which could temporarily impact its high margin personal loan business, which constitutes nearly 9% of its retail portfolio. So, these are some of the things that investors should look out for and how the bank is navigating through these challenges. The second stock in finance sector that Goldman Sachs has recommended is AU Small Finance Bank. Now, AU Small Finance Bank has transformed from a vehicle financer to a comprehensive banking institution serving more than 10 million customers. Its quarter 3 financial year 2025 results show impressive advances growth of nearly 28% year on year basis to reach 96,300 crores, with deposits growing at 24%. Goldman Sachs projects a CAGR growth of 31% for this stock between financial year 25-27, which is supported by normalizing credit costs and expanding net interest margins as funding cost stabilizes. The bank's geographical diversification beyond its core area of Rajasthan into states like Maharashtra and Gujarat offers significant runway for its growth. The risk for this stock mainly comprise of its heavy dependence on secured loan business, which comprises nearly 88%, with vehicle and home loan comprising the majority. While this reduces the credit quality risk, it puts pressure on the yields that the bank earn, because these loans are low yield businesses. Unsecured loans or personal loans offer higher yields for the bank. Again, any economic downturn affecting the SME sector will impact the asset quality in its business banking sectors. Our take on this stock, well, AU Small Finance Bank represents an interesting risk reward balance. Its recent acquisition of FinCare Small Finance Bank, which was completed in February 2025, added 11 lakh new customers, but it also brought in integration challenges. The investment that the bank has done in technology with its neo banking platform AU0101 position it well against larger players. However, investors should monitor the deposit cost carefully, as its credit to deposit ratio stands at 115%, which could indicate funding pressures. The recent revision in priority sector lending norms by RBI could impact its cost structure, as it may need to increase investment in low yielding priority sector lendings, right? So, what we recommend is to wait for the quarter one financial year 2026 results and see how FinCare integration plays out and is progressing, and then before you make any investment decision. The next stock recommendation is Titan Company. Now, Titan is a major player in the organized jewelry market with a 7% market share with its Tanishq brand. It has also diversified into watches, eyewear, fragrances, to name a few other products. The latest quarter results showed that jewelry division revenue has grown by 18% year on year basis, with an EBITDA margin of 13.2%. Goldman Sachs forecasts that the standalone jewelry EBITDA will grow at 20% in financial year 2026, which is driven by market share gains from unorganized players post implementation of hallmarking regulations for gold jewelry. Right? Titan's wedding for all strategy, targeting mid market customers, has shown promising results, with wedding jewelry now constituting nearly 25% of its overall sales. Some of the risk that we should be aware of in this stock are the volatility in gold prices, with gold prices reaching historic highs of more than 80,000 rupees per 10 grams in March 2025. Now, this could affect the demand for gold jewelry. Additionally, competition from regional players like Kalyan Jewelers and online platforms like Carrot Lane, but Carrot Lane again is fully owned by Tanishq, would pose margin pressures on Titan. Our take on this recommendation, well, consumer discretionary is one sector that is going to play out well in the upcoming financial year. Most analysts are recommending consumer discretionary sector, right? Titan is a major player in this sector. It continues to demonstrate resilience amidst gold price volatility, right? Its foray into gold exchange program has built customer loyalty by addressing affordability concerns. What we should all not ignore is the watches and wearable segment, well, where Titan has partnered with Google for its Titan Edge smartwatches to compete with global players. However, one should not ignore the PE ratio of the company, which stands at 78, which is higher compared to its historical averages. What is recommended is staggered buying over market corrections, right? The upcoming festival season in the quarter three of financial year 2026 is crucial to watch for, especially consumer response to the government initiatives to boost consumption, and how people react to their buying habits. How this is reflected in people's buying habits is what we should watch out for as investors. Additionally, Titan's expansion in GCC regions will provide a hedge against domestic consumption downturns. So this is a good long term play, but overvaluation in the current stock prices is something people should not ignore. The fourth stock that Goldman has recommended in the consumer discretionary space is Godrej Consumer Products. Now, Godrej Consumer Products has various well known brands in the market like Goodnight, Synthol, Park Avenue, then Air Room Fresheners, to name a few. Now, GCPL operates across personal care, home care, and air care segments with significant presence in India, Indonesia, Africa, and Latin America. Its Q3 financial year 2025 results showed India business growth of 9% with a consolidated EBITDA margin of 23.4%. Goldman Sachs has set a price target of 1370 for Godrej Consumer Products. Now, the company has successfully executed price hike in its soap segment to counter rising raw material costs, right? While its air freshener segment has seen double-digit growth. Uh, Goldman anticipates steady revenue growth as premium products gain traction amidst rising disposable incomes in India. Some of the risks that Godrej Consumer Products face is the price volatility in palm oil and crude price derivatives, which impact nearly 40% of its raw material cost. Also, economic uncertainties in Africa pose headwinds for its international growth. Our take on this recommendation, well, Godrej Consumer Products transformation under its current leadership of Sudhir Sitapati merits investors' attention. The company's hit list strategy of focusing on eight power brands is showing early success, particularly in household insecticide segment, which has gained 150 basis points of market share. In Indonesia, the business turnaround has been impressive with a 12% growth in constant currency terms. Investors should monitor Godrej Consumer's innovation pipeline with its entry in the liquid detergent business to challenge HUL and Procter and Gamble, who are currently market leaders in this segment. The company's lower rural penetration offers growth headroom as rural consumption revives. But African markets remain concerned with civil unrest in Nigeria and currency devaluation impacting profitability. At a PE of 45, the stock appears fairly valued, and accumulation during dips is what is recommended for long term play. The fifth stock in Goldman's recommendation is the internet based company MakeMyTrip. Now, MakeMyTrip is India's leading online travel aggregator with a dominant position in air ticketing, hotel, and holiday packages. For quarter three of financial year 2025, the gross booking growth was recorded at 25% year on year basis to reach $2.1 billion dollars with adjusted operating profit at $43 million. Dollars. Goldman forecasts free cash flows generation of nearly $300 million dollars for financial year 2026 as travel demand remains robust and operating leverage improves. The company's expansion in Tier 2 and Tier 3 cities through its My Partner franchise model opens new growth avenues. There are certain risks involved. Well, geopolitical tensions, economic slowdown could affect travel sentiments and significantly pose risk for companies like MakeMyTrip. Additionally, competition from multinational players like Booking.com, Airbnb also put pressure on the margins of such businesses. Our take on this recommendation, well, Make My Trip's business transformation post COVID warrants investors' attention. Firstly, its shift from discounting to service quality has improved the unit economics, with take rates increasing by 80 basis points to 7.9%. Secondly, its super saver subscription program now has good 2.5 million members, which assures recurring revenues and reduces the customer acquisition cost. Thirdly, its foray into alternative accommodations like villas and apartments position it well against companies like Airbnb as Indian travelers embrace experimental travel. However, challenges remain. Direct booking initiatives by major hotel chains like Taj and ITC could dismantle online travel agents' business. Correct. Additionally, the company faces regulatory scrutiny regarding display algorithms and service fees, with potential legislation impacting business practices. The stock is trading at a EV to EBITDA of 25, reflecting premium positioning but justified by its 35% EBITDA growth. Investors should consider a wait and watch approach, monitoring the first quarter results of financial year 2026 to assess the impact of new government tourism policies before making any significant commitments. MakeMyTrip is not listed on any Indian stock exchanges. It is publicly traded on Nasdaq. So if you want to invest in MakeMyTrip stocks, you will either have to open an international trading account with online platforms like Zerodha or ICICI Direct, HDFC Securities, or you can trade in it through online platforms, which international platforms like IND Money, Vested, or you can invest in this through ETFs and mutual funds who invest in international stocks. Also, opening a direct trading account with a US based broker is an option. But there are other companies like IRCTC who cater to railway travel, who is a railway travel aggregator, which plays on a similar business model as Make My Trip. So in India, if you want to invest in this space, IRCTC is an alternative to Make My Trip. These are five stocks that we spoke about in today's video. The remaining five stocks in automotive, healthcare, industrial sector, we will put out a video tomorrow. Right? This video is for educational purposes and in no way any recommendation. We were just studying the recommendations by a renowned investment banker like Goldman Sachs and just adding our take on it. What do you think of this video? What investment decisions will you take regarding this stock? Are they worth investing at current levels or will you wait and watch? Let us know in the comment section and look out for the second part of this video tomorrow. Until next time, stay safe and goodbye.